Welcome to Money Depth Insights. I am the finance guide, John Array. Today, we are going to talk about a confusion that silently destroys more money than bad investments ever do. Long-term investing versus short-term trading. Most people think these are just two different ways of making money. In reality, they are two completely different mindsets. They require different psychology, different behavior, different expectations. And most importantly, they punish mistakes in very different ways. Two people can use the same market, the same assets, the same information, and still end up with opposite results. Not because one is smarter, but because one chose the wrong approach for their personality. This session will remove confusion completely. By the end, you will clearly know which path aligns with logic, patience, and sustainability. Let us begin from the foundation. Part 1. What long-term investing really is. Long-term investing is not about predictions. It is about participation. When you invest long-term, you are not trying to outsmart the market. You are allowing the market to work for you over time. You are saying something very specific. I believe businesses will grow. I believe economies will expand. I believe time rewards patience. Long-term investing is built on probability, not excitement. It accepts volatility. It expects uncertainty. It depends on discipline. This is why long-term investing feels boring to many people. But boring is powerful. Long-term investors focus on years, not days. They measure progress in decades, not weeks. They do not react to headlines. They respond to fundamentals. Why long-term investing works? Long-term investing works because of three forces working together: time, compounding, behavior. Time allows growth to absorb mistakes. Compounding allows small gains to become meaningful. Behavior determines whether the investor stays consistent or self-sabotages. The market transfers money from the impatient to the patient. This is not a slogan. It is a pattern repeated throughout financial history. Long-term investors do not win every year, but they often win over long periods. Why long-term investors do less successful? Long-term investors do not trade frequently. They buy thoughtfully. They hold patiently. They adjust rarely. Doing less reduces emotional mistakes. Most losses do not come from bad assets. They come from bad timing decisions driven by fear or greed. Long-term investing removes the need to constantly decide, and fewer decisions usually mean fewer mistakes. Part 2. What short-term trading really is. Short-term trading is not investing. It is speculation based on timing. When you trade short-term, you are not relying on business growth. You are relying on price movement. Your success depends on being right quickly. Short-term trading requires constant attention, constant decisions, constant emotional control. It is mentally demanding. Traders are not paid for patience. They are paid for accuracy and speed. One wrong decision can erase many correct ones. This is why short-term trading is unforgiving. Why short-term trading feels attractive. Short-term trading feels attractive because it promises control, fast results, quick feedback, immediate rewards. The human brain loves this. But the market is not designed to reward emotional satisfaction. Short-term trading exposes investors to constant psychological pressure. Fear when prices move against you. Greed when positions work. Stress when uncertainty increases. Many traders do not fail because they lack knowledge. They fail because they cannot sustain the emotional load. The hidden cost of short-term trading. Short-term trading has costs beyond money. Mental fatigue, decision overload, emotional burnout. Every trade demands attention. Every movement demands reaction. Over time, this creates decision fatigue. When the mind is tired, discipline breaks. This is where most trading losses happen. Not at the beginning, but after consistency collapses. Why most people confuse the two? Most beginners mix long-term investing and short-term trading without realizing it. They invest long-term, but behave short-term. They panic during market drops. They celebrate short-term gains. They react emotionally to daily movement. This creates internal conflict. Long-term strategies require calm behavior. Short-term behavior introduces chaos. This mismatch destroys results. The core difference in one sentence: long-term investing is about time in the market. Short-term trading is about timing the market. Time is forgiving. Timing is ruthless. Why personality matters more than strategy. Some people are naturally patient. Others crave action. There is no shame in either. But problems arise when personality and strategy clash. A patient person forcing short-term trading will suffer stress. An impulsive person pretending to be long-term will panic. Successful investors choose strategies that match their psychology, not their ego. What most people never realize: long-term investing forgives mistakes. Short-term trading magnifies them. Long-term investing allows recovery. Short-term trading demands precision. One bad year does not destroy a long-term investor. One bad week can destroy a trader. Why time is the great advantage. Time absorbs volatility. Time smooths outcomes. Time reduces the importance of luck. Short-term trading increases reliance on luck. Long-term investing reduces it. This is why institutions prefer long horizons. They understand something most individuals ignore. Time is leverage without stress. What you should take from this so far: long-term investing builds wealth quietly. Short-term trading creates excitement loudly. Quiet growth compounds. Loud excitement fades. Part 3. Risk in long-term investing versus short-term trading. Risk is one of the most misunderstood words in finance. Most people think risk means loss. In reality, risk means uncertainty. In long-term investing, uncertainty is spread over time. Different market cycles pass. Different economic conditions appear. Different industries rise and fall. Time absorbs shocks. Markets go down. Markets recover. Markets grow again. Long-term investors are not protected from volatility. They are protected by time. Losses do not arrive all at once. Recovery has space to happen. This makes long-term investing forgiving. Mistakes can be corrected. Decisions can recover. Short-term trading works very differently. In short-term trading, risk is concentrated. One wrong entry can cause immediate damage. One emotional exit can erase weeks of gains. Time does not heal mistakes in short-term trading. Time exposes them. There is very little room for error. Precision matters constantly. This is why short-term trading feels intense, and why it is unforgiving. Part 4. The psychology difference. This is where the real separation begins. Long-term investors learn to live with uncertainty. They accept that markets will not behave logically every day. They understand that discomfort is part of growth. Their focus stays on behavior, not on daily outcomes. They do not try to control markets. They control their reactions. Short-term traders live inside decision mode. Every movement demands attention. Every price change demands judgment. Buy, sell, hold, exit. This constant decision pressure increases emotional fatigue. Fear appears faster. Greed appears louder. Stress builds silently. Short-term trading demands psychological strength every single day. Not once. Not occasionally. Every day. Most people underestimate this burden. Part 5. Time commitment and lifestyle reality. Long-term investing is time-light. It requires preparation, not constant presence. You research. You decide. Then you allow time to work. Your life continues. Short-term trading is time-intensive. It demands monitoring. It demands quick reactions. It demands presence. Missing a moment can mean missing an exit. This turns trading into a lifestyle choice, not just a financial one. Many people enter trading without realizing this cost. They burn out emotionally long before they fail financially. Part 6. The costs. Most people never calculate. Trading costs are not limited to fees or spreads. There are mental costs, stress costs, attention costs. Constant decision-making drains clarity. Fatigue weakens discipline. Long-term investing protects mental energy. Short-term trading consumes it. This difference compounds over years. Part 7. Who should choose which path? There is no universal right answer. Long-term investing suits people who value calm growth, who prefer consistency over excitement, who want wealth to build quietly. Short-term trading suits only those who can handle pressure, who can accept frequent losses without emotional damage, who treat it as a profession, not entertainment. Most beginners do not belong in short-term trading, not because they lack intelligence, but because the psychological demands are extreme. Part 8. The most common and costly mistake. Many people claim to be long-term investors, but behave like short-term traders. They watch charts daily. They react to headlines. They panic during drops. This mismatch destroys results. Strategy and behavior must align. Otherwise, even good strategies fail. Part 9. One simple truth. Long-term investing feels boring, but boring compounds. Short-term trading feels exciting, but excitement is expensive. Markets reward patience. They punish emotional urgency. Final clarity. Long-term investing and short-term trading are not variations of the same idea. They are fundamentally different paths. Mixing them creates confusion. Confusion creates emotional decisions. Emotional decisions create losses. If you want steady growth, long-term investing is your path. If you want speed and pressure, trading demands discipline at the highest level. Markets are not difficult to understand. Human behavior is. Those who master their reactions survive. Those who chase excitement do not. If this explanation brought clarity, share your thoughts in the comments. And if you believe this understanding can help someone in your circle, share it with them. This video is created for educational purposes only. For more clear, calm, and practical financial education, subscribe to Money Depth Insights. I am the Finance Guide, John Array, and I will see you in the next lesson.